Hey, this is Jed. I'm with Manual Mortgage, and today we're going to be talking about three major components that the banks will be taking a look at when you try to qualify for a home loan. These three major components that the banks will be taking a look at when you qualify for a mortgage, I like to call it the 3 C's. The first C is going to be credit. When we talk about credit, when the banks are talking about credit, they're talking about anything that shows up on your credit report, like bankruptcies, foreclosures, student loans, auto loans, credit cards. But primarily, the banks will be taking a look at are your credit scores. So if you have a credit score of 740, that's what the banks are going to be taking a look at and going to be considering as excellent credit. Now, there are 3 different credit scores or 3 credit bureaus. There's going to be TransUnion, Equifax, and Experian. Now, these are the 3 bureaus that all the major banks will take a look at when you're trying to qualify for a loan. So if you have a credit score of at least a 600, maybe 620, 640, it really depends on what the rest of your last 12 months credit history looks like. But that's what the banks are going to be taking a look at, credit. So the second C I like to call is what they call capacity. When the banks talk about capacity, this is what they call the debt to income ratio. This is the amount of money that you bring in per month, whether it's a W-2 income, self-employed income, retirement. We talk about pensions or annuities, the different sources, but primarily it's the amount of income that you bring in on a monthly basis. We take that amount that you bring in monthly in income and take in the amount of debt that you have that shows up on your credit report, along with the amount of home that you're trying to purchase, and that's where you come up with the capacity. Different banks and different programs have different types of debt to income ratio maximums, and so it really depends on what the program that you're looking to qualify for. The third C, what we call collateral. When we talk about collateral and the banks mention collateral, this is the actual home that you're buying. So if you are trying to qualify for example, a home of $250,000, that home needs to appraise for at least $250,000 or more. So that's the collateral. So we're not going to know exactly what that third item is going to be until you actually go under contract, have an executed contract, and have an appraisal order. So as long as that appraisal comes in at that quote $250,000 or more, then you should qualify for that loan. Now, important factor here is that you have to have all 3. You just can't have one or the other or 2 out of 3. You have to have check marks by all 3 of those boxes. Your credit, the qualifying credit score, your capacity is what you call debt to income ratio, and that's got to qualify as well. And then the appraisal, which you call the collateral, the amount, the actual home that you're purchasing. You have to have all 3 of these items in order to be considered to be pre-approved and then begin the process of beginning to find a home. Once again, these are just basic understandings and basic guidelines of qualifying for a mortgage. The answer always depends on your particular scenario. So if you have any questions regarding to a particular scenario or questions that we can answer, feel free to shoot us a comment and we'd be happy to answer that for you. Hey, thanks again.
Thank you.